Most conversation about IBC tend to be about two things: recovery percentage and timelines. And fair enough, these are probably two important and easy metrics to track. But today, we will try and zoom out a little and understand the impact of IBC beyond these two numbers. What is the impact of IBC on the broader economy, on the debt market, and also with the NPA cycle down from all-time high to all-time low, what is the future of IBC? I am Pulkit Gupta, partner, Debt and Special Situation team at EY, and I welcome you all to EY India Insight series. I'm delighted to be joined by Amit Agarwal. Amit is CEO Edelweiss Alternative and also is a founding member for their private credit business. Amit has more than 25 plus years of experience and has had a front seat view to the entire journey. Welcome, Amit.
Oh, thank you, Pulkit. Thank you for inviting me here. And hopefully this podcast will be a little bit of help for all our clients and investors who want to understand what's changed over the last decade in India.
Sure. So Amit, to start with, if we can go back to 2016, in your experience, do you think IBC has achieved the intended objective?
So I think I would rather go a little bit more back. And I think when I was with asset reconstruction business in the early 2000s, I would see that the banks and the lenders used to really be very worried about any default. And they did not know exactly what are the recovery measures that they can take. So in fact, if you go to 2006, which is like literally 2 decades back, I think the lenders were not as confident if the asset was going sideways as to what to be done. I think bankruptcy code has brought that semblance to the whole thing. You have a structure and you have a fundamental basis of getting these companies to a final resolution. So I think it has been one of the most important systemic changes, I would say, for the creditors and lenders, and the entire framework has been extremely helpful. I'll give you a small context because we raise capital from our global LPs. So we keep on going to other countries to see how they perceive the Indian bankruptcy code. To give you context, US bankruptcy code was done by the Bankruptcy Reforms Act of 1978. And they were doing bankruptcy code 100 years before that as well. So even from late 1800s, they were running their bankruptcy process. And it really started in US around 1980s, early 1980s, where they wanted to really implement the bankruptcy code. And the US economy was a 4 trillion economy at that point of time. So if you see, it is very, I would say, coincidental that when India sort of launched its bankruptcy code in 2016, we were also a $2.5–3 trillion economy, and today we are a 4 trillion economy. So if I was to correlate, it is a very similar situation to where it is. And in fact, India has crunched 100 years of evolution of bankruptcy code of various geographies into these last 10 years. And this is one of those codes where we have seen very proactive movement, multiple changes, multiple amendments, a lot of conversation with the industry stakeholders to change. So I do think that the bankruptcy code has achieved a lot of intended objectives, and everything can be evolved. Like US was always evolving its bankruptcy code, and it has taken a very long time to reach here. But I think we have achieved a lot over the last decade, and with this latest reforms that have come in, I think we have really starting on a very good note. Sure. And from here, it will be the next 10 years, we will see literally a very different bankruptcy code and a very different regime, a lot more acceptance.
Sure. So is there anything which you say that really stood out for you, like from 2016 till now, which has surprised you positively in terms of what has been done by the IBC during these 10 years?
No, the biggest, I would say, the surprise, or what I would like to say, the biggest feel-good factor that we have seen is the credit culture shift. I think the whole credit culture shift has been a very systemic thing, and which itself is a very heartening factor. Now, nobody is signing corporate guarantees as they were a worth of, not even worth the paper they were written on it, right? So now people, when they ask for corporate guarantees or they give corporate guarantees, they very well know that the companies that are writing the corporate guarantees will have to meet those corporate guarantees. This was not the case before the bankruptcy code. So I think the people are borrowing only if they think that they will be able to repay. I think that fundamental credit culture shift is the most heartening part of it. And I think as a lender, I feel, and I have been a lender for now more than 2 decades, I think the last decade I have felt a lot more confident about lending than in the previous decade.
Right. Interesting. And if there is anything which you would want IBC to do a little better in the next decade, what is it which kind of disappointed you as compared to what you thought we may achieve in 2016 till now?
So there can always be better at all points of time, right? Like even a great sports person can also improve every year a little bit more from what he was in the previous year. But I think we have achieved a lot of objectives. And just to make sure that the spirit of the bankruptcy code is maintained, we are able to give honorable exits to businesses. We are able to get the enterprise value allocated largely to the creditors in the stack that they have lent. If we can maintain the spirit, I think it will be good. I do think that what can be immediately done better is to have a little bit more, because there is a lot of backlog that gets created in India of cases and so you can improve a little bit more bench strength around bankruptcy courts to reduce their pressure, maybe have a little bit more of judiciary augmented in those courts to make sure that they are able to give time and are able to give out the judgments. Because it's also, the judgments are also very detailed and they have to have a very strong rationale. So just augmenting a little bit more capability on the infrastructure side of the bankruptcy courts, I think will be a very good outcome.
Sure. And you touched upon your interaction with global investor. How do they look at our 10-year journey in insolvency? Because I remember I was in EY UK in 2014 to 16, and everybody used to say that India is good at introducing law, but the implementation always lagged behind. And is that a good enough protection for them while investing in India?
I think results speak for implementation. We have recovered more than $40 billion over the last 10 years. I think bankruptcy code now accounts for what, like 65-70% of the recoveries that the banks do. So the proof is in the pudding, right? So I think we are at a place where people now understand that bankruptcy delivers results. I think we took an ambitious target of trying to resolve everything in 1 year. Even in US, the bankruptcies do extend for multiple years at point of time. I think we have cases which have extended beyond the statutory time period. But our experience with the bankruptcy code is that if the asset value is strong and the creditors are similarly placed and there are not too many creditor or intercreditor disputes and the asset has value, the bankruptcy code actually works very effectively. And I think that is the perception which is also now with the foreign creditors. There are few segments like real estate and all where the resolution is still a bit more difficult in the bankruptcy code. But I think outside of that, like corporates, let's say if you have a steel company or a cement company or a road asset, if it goes through the bankruptcy process, I think the process is quite seamless now.
And also, I think there are two benchmarks which largely are used to measure IBC success, which is the recovery rate and the time it takes to complete the process. But what has been your experience beyond these two benchmark things? Like you spoke about the credit culture improving, you spoke about the confidence of the global investor improving. I think one thing which does not get covered a lot is the value which gets unlocked once an insolvent company is taken over and then turn around, and then the value which gets created for the investor. So anything you want to share on those lines, your experience of investing into distressed companies and then a turnaround story there?
No, in fact, that's a very important point. And I remember when we were, even when the bankruptcy code was being formulated, and see, in bankruptcy code, the government has put its dues way below the secured creditors in some sense. So there was a lot of conversation that we are giving away the government revenues or the taxes. But the logic that came, and I think which was a very absolutely perfect logic from the government side, was that we are also unlocking a lot of value. We are making the dead assets workable, which would then otherwise be stuck in liquidation process for a decade or so.
Yeah.
But we are also generating new revenue, fresh ecosystem, and the fresh taxes will more than take care of the loss that the government is making maybe on those dead assets, because those are anyways lost cases in the hands of those promoters who don't have the wherewithal to run those businesses. So our experience has been quite good. In fact, very interestingly, and I don't know whether you have seen this because you are also run a lot of insolvency processes. An interesting fact has been that the EBITDA after going to the bankruptcy has actually improved in multiple cases. So even when the existing management was running it, we have seen the bankruptcy processes, the EBITDA increasing during the bankruptcy tenure itself in multiple companies, which just shows that those companies are inherently very strong. But because of, let's say, the default related issues or people not trusting the management or whatever it is, the companies are actually bogged down in the crisis. And as soon as you apply a moratorium, as soon as you put a structure to the whole thing, the companies blossom out. There have been dead assets which would have been stuck for a very long point of time. They have become really viable, and they're not only running, they're actually thriving. So it's not only a, what I would say, a single focus of just making the assets viable. They could become thriving, and they could even build more jobs, create more capacity, add towards India's future. So I think it has done a fantastic job of bringing those assets back to life.
Because we've had situation when we run insolvency cases where suppliers will come back and tell us that they are so happy with the payment structure and the payment discipline which is maintained during insolvency that they would rather company continue in the insolvency because they get paid on time as compared to what was the case before insolvency. So that's interesting because a lot of this capex is adding overall into the GDP of the country.
And I think the recovery rates are very strong. In fact, I keep telling, and we do this when we meet our clients, the recovery rates in averages are maybe very misleading actually. So you could have companies who don't have any asset value. There could be holding companies, there could be companies which have been stuck in a liquidation sort of scenario for a very long time, don't have any assets. So there are recovery rates that are very low in companies. And if the asset is strong and the creditors run the bankruptcy process very neatly, then you have much higher recovery rates. So actually the recovery rates for asset heavy industries, if there was data and could be segregated, you would see, and we have some data which we have created which is basically on some framework, but anything that is asset heavy and is operating has got a significantly more outcome and recoveries than assets which are non-operating and don't have any value.
And so moving on, I think Amit, one of the topic which is close to your heart, I know, and has been a big success because of the insolvency code is the private credit market evolution. So how do you see, what role has IBC played in giving the downside protection risk for the private credit investors?
In fact, again, I'll go back to a little bit of US analogy. So post 1985, which was where US was a $4 trillion economy, they have grown over the last 4 decades at average of around 5%. Today they are more a very, very large economy, as we all know. But the private credit market, even in US, if you see the Milken bonds, the growth of junk bonds, the high yield market, everything got really, really boomed after the bankruptcy code was put properly in place. So between 85 to almost 2005, the private credit market there grew at 15 to 20% pace, backed by the bankruptcy reforms. So, and I think that a similar thing has happened also in India, that the private credit market has benefited. Because at the end of the day, private credit is a flexible financing solution. It is a capital solution. Like a special situation fund is effectively a capital solutions fund where you're solving for someone's problem. You're giving him cash capital across various debt stacks. You could give him senior debt, you could give him mezz, you could be the sole creditor in the company. So private credit market wants certainty. The investors in private credit market want certainty. that if the company goes to bankruptcy, then actually
They'll
they will
recover.
be able to get at least the enterprise value. They also understand the risk, but they understand that the enterprise value of that should get recovered. And I think that confidence really helps the investors in investing in the market. And the latest reforms will further actually embolden or increase the confidence of the creditors that the government is actually very focused on making sure that people who borrow also repay.
Yeah. And if we sort of extend this, you've seen this for last 20 years, if we extend this for another 5-7 years, where do you see the private credit market evolving? Because was it an opportunistic thing which happened in last 3-4 years where bankers were not actively participating? Or you think it is here to stay and it will continue to grow?
Private credit is structural. So I don't think private credit is an opportunistic thing. It is very structural. It has been structural across countries, across geographies, in multiple ways. See, at the end of the day, still 93% of the lending is being done by banks and NBFCs. So India lends approximately around $200 billion a year currently.
Yeah.
And the private credit market is somewhere around $12-13 billion annually. You will have one couple of deals of $2-3 billion, but outside of that also there is a thriving market. So it's hardly 5-7% of the market if you see. And that sort of requirement, whether it is a mezzanine facility, it's a facility to grow, it is a capital solutions situation. I think this market is there. And if you really think about it, in the next, and I don't have an answer for 5-7 years, but I have an answer for a decade or 2 decades, that if our economy has to move from $4.5 trillion to a $9 trillion dollar economy in the next 10 years, the credit also from an annual lending of $200 billion has to go to $500 billion. And even if the market of private credit remains at 7% or just goes to 10% also, you have a $50 billion annual deployment opportunity. So the private credit market is there to stay because the solutioning needs for the corporates will remain there. So I don't have a doubt about the private credit market, but a strong bankruptcy code is really the backbone of the private credit market, which I think has done fabulously well.
And for this growth of private credit to be sort of sustained and supported over the next 10-15 years, is there anything you would want from the policymaker in the bankruptcy code to sort of look at over the next few years, which can further help the private credit market growth?
So I think the first is obviously it's very important to make sure that the code's spirit and the intent is maintained. And I think which is already there, that I think that the government's intent is very clear as they pass this amendment bill, and that's fantastic news for the private credit market as well. I think the few things which are already there in the code can be actually improved. Like for example, all of these companies that go into bankruptcy, one of the biggest, I think, I would say an area of, I would dispute, you may call it, or discussion, is how to get new or fresh capital into these companies. Like that is a very evolved process in US today. The DIP financing, what is called the last mile financing, which is called interim financing in our bankruptcy code. I think that needs to be a very standard product. It doesn't need to be that much of a discussion because when a company goes into bankruptcy, it needs capital. So I think if we could have some arrangement around making interim financing
a little more accessible,
accessible in a very clear-cut way. Like if you are admitting a company of, let's say, 1,000 crore debt, then 5% of that or 50 crore of interim financing, you will not have to have a discussion or it's automatically allowed, or 2% or 1%, I don't know. But infusing that interim financing into the business will actually make sure that the business value is protected. Because we have seen cases where there are very immediate capital expenditure requirements to even safeguard the basic assets of that company. And because the lenders are not getting around whether that capex needs to be incurred or not needs to be incurred, because it impinges upon their asset value, that asset actually deteriorated significantly.
It will definitely have unlocking the value during the insolvency.
The idea has to make sure that the value gets unlocked, and there has to be an easier way of delivering interim financing to some of these companies that go into bankruptcy court. And the second thing, as I said, I think the infrastructure needs a little bit more upgradation, or I would say maybe more addition of judges and more informed lawyers, and the whole community, I think, has to come together and make a more vibrant ecosystem on the bankruptcy side.
Sure. So, with your experience now, over 25 years, 18 years with Edelweiss, young kids coming out of college, trying to make career out of distress investing, private credit, what would be your suggestion? How should they look at this as an opportunity to maybe make a career out of?
I must tell you, any kid coming out of the college, if you say you want distress investing, the word itself will have a challenge. Nobody aspires to do distress investing when they come out of their college. At least I didn't aspire to do distress investing when we entered. But I think, leaving apart the word, just credit as a whole, as a country, we will see a lot more talent coming up. There will be a requirement of talent in the industry, the private credit industry, the lending industry, the bankruptcy code. I think anybody who is looking at this sort of avenue as their career, they should be clear that it's nothing which is very fast, right? You'll have to spend time and be at it for some time, and this will give very promising career returns for people, because this is not an area which is very crowded at this point of time. It's not like too many people are working towards that. Private credit, yes, everybody would like to come into the private credit. But as a creditor, your understanding of how you will recover money is going to be as relevant, or maybe in some cases more relevant, than your understanding of how to lend money. Because only when you have made mistakes in the past, you have gone through cycles and you have seen how to recover the capital, do you understand the importance of how to lend and how to get to the best outcomes.
Sure.
But I think all the freshers who are coming, who are wanting to do credit, they definitely need to have a good understanding of the bankruptcy process and the systems, and their understanding of recovery of money would actually drive how good a lender they will become.
Yeah, great. I think we've covered a lot. Any closing comments which you may want to share around private credit or around the evolution of bankruptcy code?
No, I think those two segments are very intertwined. I think private credit will need a strong bankruptcy framework in India to continue, and private credit will also grow, because I missed out on telling you that, but India GDP has always doubled every 8 to 10 years in US dollar terms. So it's not a number of 9 to 10 trillion we are saying. We will see a 9-10 trillion dollar economy, which will need a robust bankruptcy code, which will need robust credit markets, which will need a very strong talent pool to sustain all of this. I think as a closing comment, I would like to say that it is very important for players and many other institutions also to keep creating the ecosystem, to keep giving the right suggestions, to see that the right things are done in the industry, and the implementation continues to remain the way it is today. And it is a responsibility on all of us to make sure that there is nothing that is happening in the industry which is bringing bad name to the industry for any reason whatsoever. It is also important that we continue to focus on the enterprise value building and the value unlocking of these assets. Moving fast and moving early wherever you see a problem is the core of actually recovering the enterprise value, and which is what bankruptcy code also does, that you don't wait till the asset to really stop working and then only get into that. So all of us who are part of the industry, as in when we see problems, kicking down the can down the road is not the best outcome. Rather, we face it upfront, get those solutions. Like CIRP, the latest one where the debtor in possession regime can be created, is a fabulous way of identifying problems early, solving those problems early, and getting a closure to these things. I'm very excited, and I'm looking forward to the next decade with great opportunities and for private credit and bankruptcy code both.
Sure. Thank you so much. I think I thoroughly enjoyed the conversation, and hopefully the audience would find it useful. And I look forward to maybe come back in few years' time and do this again, and we see where the bankruptcy code and the private credit market is. And thank you again, Amit, for taking out time.
No, this was absolute pleasure, Pulkit. Thank you for having me here, and we will all be in this journey together. So we will keep catching up on this.
Thank you.
Thank you.